But my next guest says while he believes Chair Powell has nailed the fight against inflation so far, raising rates from here would be a mistake. Joining me now is David Zervos, chief market strategist at Jefferies. You know why I love you, Dave? Because not many people come out and pound the table about how great and how right the Fed is. And you've been doing it for months, and you were right about after SVB. And I mean, I won't go on and on, but, you know, I give you credit.
Thanks, Kelly. Although I'm not necessarily calling against the next rate hike. I certainly think they're hiking rates next week. I was just making a point in my last piece, which I think is what you were referencing, that, and I've made this point many times, and it's fallen on deaf ears, and I've been dead wrong about this one, which is I think they should be considering some asset sales, especially with long-term yields as low as they are and mortgages tightening up as much, and the housing market so strong, even though we got a little bit of weakness today.
But they might say, why do we need to do anything other than what we're doing? Because according to you, we've been masterful.
We have. I'm fully on board with the masterful idea, and I'm fully on board with another rate hike. And if we get a couple of 0.2s on the next core PCs and CPI, but we'll get them in CPI. If we get them in CPI before the September meeting, I think they could pause for sure. If we get 0.3s on either one of them or above, I think they'll probably go again. But I guess I just throw it out there as, hey, if inflation doesn't come down as fast as they're thinking, if we're not getting down to 3.9 to 3.6 on core PC by the end of the year, why not consider the asset sales instead of another hike in September or another set of hikes? There's people out there that think they're going to go, to 6 or 6.5% before all is said and done because they're not very optimistic inflation outlook. I just throw it out there because I think there's a lot of things that can destabilize in the front end, and the long end is just traded so well. It's giving them an opportunity to at least prep the market for it if it's needed. I don't think it'll be needed, but if it's needed, they should think about it.
People hate the balance sheet. The investors hate talking about it. People insist there's no correlation. I think the Fed hates it. I mean, they tried to shrink it in 2019. They saw the repo crisis. We say, well, we're twice as big now. What could a little shrinking do? And I don't know. I think everyone's afraid of it.
You're right. I'm just, I've been pounding the table. Look, I used to write about this stuff back in, 2014, 15, when we were lifting off on, my belief that asset sales were a part of the program. So, look, I mean, we've had some good calls. We've had some bad calls. I certainly thought they would consider asset sales more aggressively. I don't think anybody wants to have these mortgages on the books. I think they just got kind of convinced by the big banks that raising rates was a little bit more was just a little bit more traditional and a little easier. And by the way, given what's happened with bank earnings in this latest round,
bingo,
the banks have won the debate. They got what they wanted. Their NIM is really big.
No, it's exactly, and for anyone who missed it a couple months ago, I mean, you made this prescient call that you thought the reason why there wasn't more fallout from these rate hikes a la 1994 and Orange County's bankruptcy and all that is because it was all in the Fed. The Fed owns all the mortgage-backed securities. Who's going to take the losses when they own them all? So why would they sell them now? To your point, no, there would be no buyers. Mortgage rates would spike further. I mean, it'd be bad for everybody.
Well, let's play devil's advocate a little on that, Kelly. The current coupon mortgage right now is about a Fannie 5.5. They've got a few of those, not too many. They've got more 1.5s and 2s. But as I pointed out in my note last week, they've got about $300 to $400 million worth, $1 billion of high coupon mortgages. That's not a trivial amount. We did $600 billion in QE2. That was a big number. So letting $300 or $400 billion go instead of a couple of rate hikes, I think is worth talking about. And those are high coupon mortgages that all trade at $90 price. They're seasoned. That's paper that the market would love to get their hands on. So I think they could nuance this. But look, it's a fun debate. It really annoys a lot of clients because particularly mortgage clients. So I like to write about it and get people a little riled up in the summer over things. But, look, we've had, I think we had some nice calls on the SVB thing. We've had some other calls that worked out. The asset sale call was one of those things that just did not come to fruition for me overall.
But again, there's sort of what they should do and what's right. And we appreciate you writing a little bit of both, So, Dave, thanks so much for your time today.